Now let's understand who are institutional investors. So institutional investors can be individual, or those individuals should be a non-bank individual or institutions which deal in large enough share quantities or dollar amounts that it qualifies for preferential treatment and lower commission. That would be the definition of institutional investors. They should be making investment they'll be buying the large quantity of shares, and they'll be spending a lot of money for these investments. That's the example of FIIs in India, that is foreign institutional investors. So the institutional investors get the preferential treatment. Obviously the commission is low. Institutional investors face fewer protective regulations from the government as well as the regulator, since it is assumed that they are more knowledgeable and they know how to protect themselves better than the retail investors. Now examples for institutional investors could be pension funds, life insurance corporations, or any other institutions which qualify for huge investment and are non-banking in nature.